All right, so stocks have been on a little bit of a losing streak the last couple of days. So is that it? Is that this losing streak? I'm going to show you some resemblances to this type of losing streak that we've seen in the recent past, these last few expiration cycles, that have signaled some opportunities for a bounce, that we can come right out of it into the weekend and just continue to buy the dip and continue to be bullish. There is one little bit of a red flag that we haven't been seeing. In fact, that has not been getting a lot of attention at all. A lot of the attention's been on the Qs, and all the attention has been on the Russell 2000, and then we had one index today of those major indexes, which has not been getting a lot of attention, which may be a canary in the coal mine, so to speak, because of the patterns and signals that it's giving at a very, very important inflection point for it, and that could bleed over for the first time since last September into all of the major indexes and not just this individual one. So I'm going to break that down and to show you what those patterns are. Our trade idea is a stock that's really not going much of anywhere and will allow some opportunity for either downside or upside moves. We'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, September the 8th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator here. As you can tell, we maintain a very strong bullish posture. As crazy as today's moves were, crazy, I guess, depends upon who you pay attention to, but much was made out of today's little selling, and for that matter, the last few days. I mean, we've had, what, 3 down days in a row? But even today's move, which actually looks a little bit more volatile than what we've seen in the prior 2 days, was a below average trading range, as you can see right here. Very, again, barely, but keep in mind that that trading range is extremely low right now. So when you look at it from that context, well, today's move is not very crazy at all. It brought the near-term line down. It's interesting. The last time the near-term line got, there's been a few instances of the blue line getting into bearish territory. You can see usually when the blue line gets into bearish territory, the price down here gets close to the moving average, or maybe even goes below the moving average. You can see an instance there, an instance there, obviously an instance there, and so on, right? An instance over here. But you can see there was a few instances, like one here, where we were above the moving average. We came down a little bit towards it, but didn't quite get to it or below it. And then another one right here, where we were well above the moving average. So it's very similar. Now, granted, that one got below 20 on the near-term line. This one got down to 20 on the near-term line. This one's not down, so maybe we might have another day of the near-term line coming down. But you have the momentum line in bearish territory. You have the near-term line, and has been for like the last week or so, again because of smaller ranges. You have the near-term line down here in bearish territory. The expectation is that we'll just come out of this, just like we saw, especially considering that we are a percent above the 30-day moving average, that we'll just bounce off of this. Again, not get very much higher, because you can see we typically get about 2% above it right now. So it's not going to be a big move to the upside, but doubtful that will continue and really kind of break down here to the downside. That's the S&P 500, of course. You look at all the other indexes, they all look very similar. Interestingly enough, the Dow Jones Industrial Average is now the most bearish one. It was the Russell, right? But look at the Dow Jones is actually below its moving average by 0.5%, which is rare. It's unlike the other indexes. You can also see too, in fact, we have to kind of move this, don't we? We have to move that 0 line up to that peak over there, still maintaining the low point, and you can see too the market. This is the market sentiment line. Would need to come up over here too. So there's that long-term market sentiment kind of matching up around the 31,000 and 31,500 to 32,000 range on any kind of intermediate decline that we may get if we break down below the 23% retracement level, of course. Which is when those start. But you can see the moving average is actually falling. That's why it's red. Otherwise, it'd be yellow, right? If we were below the moving average and it was rising, it'd be yellow. But it's red, which means we're below a falling moving average. The short-term sentiment is relatively bearish. We did fall below 20, not extreme. We don't have an extreme low on the momentum line, but you notice the intermediate line is almost falling out of bullish territory. And in fact, one more day and it probably is out of bullish territory. So it's got a really important inflection point where we either, again, small ranges, it's about average, considering again the average is very small. But it's, we're kind of either we bounce off of this and come back up, or this might lead into something more. So it's kind of interesting to see the Dow being the one that's different this time. The NASDAQ looks just like the S&P 500, a little bit of a bearish divergence coming on that near-term line. We've been on this near-term run now here for the last however many days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 days. So a pretty mature near-term rally coming off of that low point before August expiration. You can see we are still 2.5% above the moving average. And then finally, the Russell 2000, very bearish short-term sentiment, right? So obviously much more bearish than what we saw. The momentum line did get to an extreme low point, which is more typical for the small cap index. The higher beta index is more volatile. But the near-term line also dipped well below 10, right? It got below, well below 20, even got below 10. Almost got the 5th percentile itself. So pretty bearish. You can see like we don't typically get that bearish in the near-term line while still maintaining, bullishness. Like, look for example in here, you can see we dipped pretty low on the near-term line, again below 10. See, these two didn't get below 10. This one got to 12. That got to 10.93. Over here we finally got below 10. Got down to the 5th percentile. We were well below the moving average. Go out further. Over here we got below 10. Not on that day, but on this one right here, and we were again well below the moving average, flirting with breaking down. None of these other instances did we get down below 10 until, some over here. You can see this was the last time that we were kind of below 10 and above the moving average before kind of having that little, this was a leg lower on the intermediate decline on the broader markets. Remember that dropped down to the Halloween low point we bounced off of. And then again, let's go back prior to that. So right in this area here. So again, there's that level. You can even see during the actual intermediate, during its intermediate decline, the near-term line never did drop below 10. Where was it? Over here, never did drop below 10. Didn't drop below 10 to the very end of the intermediate run that the S&P 500 had, right? And then you can see another instance over here, dropping below 10, above the moving average, or actually a smidgen below it. But that's how big of a move it was. So pretty significant for us to get a near-term line that low and still be relatively, about 1% above the moving average, 30-day moving average there. So it'll be, again, kind of one of those inflection points. We either come right off of this, or it might lead to something more. So very, very important day tomorrow, and for that matter, Friday, as to how we finish this week off. So let's take a look at some of these other charts as we normally do. So let's take a look at the long-term chart here for the S&P 500, and you can see it's still a very bullish candle, of course. The Hakinyashi differential, as you can see, if I zoom out, it's easier to see, just how small the weekly candles are getting. So 2017, kind of a very similar time frame where we were really, really small on the Hakinyashi candles. We started to get bigger as we hit that parabolic move there and peaked. So we're not necessarily doing that right now. We still have a very, very strong PPO, much stronger than what we had in 2017. It's actually stronger now than it was at the peak, at the parabolic peak. And this is apples to apples, a normalized number, so we can compare it to now to then. And again, this kind of shows how strongly bullish we are now. I think we get a little desensitized to how strongly bullish this run is because of how small the moves are. But the reality is the trend is still very strongly bullish and has been this whole time, because again, like that peak in early 2018 was insane. It was a parabolic move. We got parabolic moves across multiple time frames. We talked about it in the market outlook videos. That was right when we were starting Market Scholars. We were doing market outlook videos earlier that year. We talked about taking risk off the table because of how parabolic the move was and how long we had been bullish, and things were kind of going crazy. Well, the long-term trend there that we ultimately hit the peak on at 6.69%, 6.89%, excuse me, is lower than where we're at now, where we have been for the past however many months, where we've been this kind of grinding higher. So this again shows how strong this trend was. You take a look at the Russell 2000, and you can see the candle here getting smaller this week than what we had last week. And that was a pretty good bullish candle, not following through with a good bullish candle this go around. The Dow Jones, take a look at that one here, because that's been the more bearish one, and look at what we have there. So we are down to 5% now, so we're falling much more than the NASDAQ and the S&P has been. We have a negative Hakinyashi candle. We've gone below zero here, and we actually have you can't see it, there it is. You can see the red arrow up here, which means we've crossed below the 50-day moving average, which is a signal of intermediate decline. So that's interesting pattern developing on the Dow Jones, and of course the Russell 2000. Well, we already shown you that one. NASDAQ 100 is the one I wanted to show. You can see again 9.5%. It's it's got the strongest long-term momentum out of all of it. And again, compare that to early 2018 when things went parabolic. It was at 8.5%, and we're at 9.5%. So we're stronger again now than we were there when things were nuts. So it kind of puts in perspective just how bullish we are right now, how bullish we have been, even with these small grinding moves. Let's take a look at the 3 green arrow charts. Of course, we don't have 3 green arrows anymore. We have the 1 red arrow here. We never did get in fact, we have 3 red arrows now on the Dow Jones. We have light pink shading here. We still have 3 green arrows in the Qs. But you can see the histogram is falling, so we're in bullish convergence mode there. Same thing with the Russell, right? We still have 3 green arrows, but we're really close on both of those to getting at least 1 red arrow. So kind of an interesting dichotomy. We go from 3 red arrows, which remember, 3 red arrows can be a really good buy signal. I know that it was 3 red arrows is always positioned as a kind of a sell signal at Investor's, but the reality is, look at the last 3 red arrows the Dow Jones Industrials have. That was a bounce, and that was a bounce. So 3 red arrows is actually a pretty decent buy signal. So again, we either bounce off of this, or that's the last 3 red arrow signal we get before we start an actual intermediate decline there. As you can see, none of the others are giving. Only the S&P is getting you 1 red arrow there. Let's take a look at the 2-line versions of the chart, and let's take a look at the diamonds first. As you can see, we are below the 30-day. We actually broke yesterday below the 8-day. So we were above the 8-day the prior day. We broke below the 8, 17, and 30-day moving averages all in one day, and then was flirting with the 50-day moving average. So again, we bounce off this support, 50-day moving average, strong volume area here. We bounce off this support and continue the grind, or we break down into something more, right, and fill in the gap, start trading in the gap between the 50 and the 200-day, which is a pretty wide gap. As you can see, the MACD and stochastics rolling over there. Obviously, that's not the case for SPY. We are still above the 17-day moving average, and not the case either for IWM, which, as you can see, we kind of stopped today at the 15-day moving average. So inflection points all around for a lot of these major indexes going into the last 2 days of the week, which traditionally has been positive for stocks, is to finish. They've been finishing the week strong here lately. Let's take a look at some of these other indexes. SPY, which is not showing a directional move anymore. We are back above 20. We're back below 30. So no more directional move on the S&P 500. That one's over with. The Qs just barely has ended their directional move. IWM never did have one. The ADX is continuing to fall. In fact, look at now the positive indicator is actually broken up above the negative indicator. So never did really get a good directional move popping out of there. The diamonds, we are that close to getting a bearish directional move. Isn't that crazy? We're almost above 30. We're already well below 20. The ADX was extremely low and setting up for a breakout type move. Come down here to RSI, CCI, you can see still bullish territory for SPX and the NDX, good strong bullish territory. The Dow Jones Industrial Average, not so bullish. Now, not strongly bearish either, like we're below 50, we're below 100, but again, inflection point. We either bounce off of this like we've done before, or we don't, right? So, or we break, make a move closer to down to in a stronger negative territory or below 40. So very, very important day for the Dow tomorrow. And then of course the Russell back to neutral. Like it made a fling up in bullish territory, but like it did on June 8th, which in the prior market outlook videos, on Friday's video, we really compared this run right now to June 8th, to that run there, where it looked like it was really bullish, but really wasn't as a breakout move as we thought. Well, doesn't look like it's as much of a breakout move as we thought. Again, so just like we were talking about in the last couple market outlook videos I've done. Let's take a look at the Bollinger Bands, SPY in neutral territory again in the middle. It's still, in the upper part of the middle, but still down in neutral territory, so not as bullish. IWM also tried to get into bullish territory and now is not, right smack dab in the middle, right at its point of control, no less. The diamonds, however, in just flirting with a lower quartile, low bandwidth too, so it's setting up for a breakout move, right? So here the bands are inside the Keltner channels. Remember, we're at that volume support, we're at the 50-day moving average, so a break below the lower bands, both the Bollinger and the Keltner, would be a kind of a sign, a signal. Now we kind of got that over here, and it didn't hold, right? In fact, we kind of, it was one day after another, but when you get the break below or above both at the same time, even over here, you broke above the bands and then the Keltner channels. When you get above both, nothing's 100%, nothing's 0%, but it increases the likelihood of a breakout when you break out of both of them when the Bollinger Bands are inside the inside the Keltner channels, which means you have a red dot down here. It sets you up for a green dot, which is the breakout type move. So not quite getting that there, but you can kind of see that they still got a very strong trend on the S&P, still got a good intermediate term trend on the Qs. IWM tried again to get above 2 and 65 and failed again, just like it did back in June 8th. And now it's back to barely above 1 and barely above 50, which means a very weak trend back just a smidgen below the green line. So again, inflection point. We either bounce off of this and continue to grind, or it leads to something more. Let's take a look at the diamonds, and you can see no more bullish trend, right? We were, we had an intermediate run going. We were above 2, we were above 65. We weren't quite above 5 and 80 to really, establish it and then grind. But we had a bullish enough of a trend going that we were around 70 and around 2.25. So we were above those levels. Not anymore. We hit 0 on both of those today. No more bullish trend. So very important mark there for the diamonds, suggesting that not nearly as bullish as we've been. Let's take a look at the intraday chart, and you can see SPY lower high and a lower low, but we close at last week's low point and at yesterday's low point. So it was bearish early in the morning, but then we rallied and finished at a relatively neutral level, not as bearish as we thought. IWM, not so neutral, right? Lower high, lower low, closed below yesterday's low point, well below yesterday's low point, and for that matter, below last week's low point. So relatively bearish candle or bearish move there. The diamonds now has a couple of days in a row of bearishness. Lower high, lower low, closed below yesterday's low, well below last week's low, well below the week before's low. So a lot more bearish, and you can see in an area of very, very little volume, both to the upside and the downside for that matter. So interesting development on the diamonds, the Dow Jones Industrial Average, that's suggesting a little bit more bearishness than what we're seeing. So looking at the volume today here, so let's go back to the green arrows. And you can see the range again, 2.81. This is a smidgen below the average. Volume at 56 million shares. So let's put those numbers into context here. 56 million shares is below the average, so right about there, and still relatively low compared to the 52-week range for that average. And then, of course, the range today was below the average, which is the low point of the 52-week range. So it's extremely low, and it's again at this 0.65% mark, which is well below 1%. So it's well below, anything below 0.75% is extremely low, and that's where we're at right now. But you wouldn't expect that we are extremely low when you look at the VIX, because the VIX, while it is, flirting with 80% here lately, and has ramped up the last couple of days, is not below 15, which is what you'd expect with low ranges and low volumes and low volatility. You'd expect that we'd be, or low volatility here, you'd expect that we'd be well below 15. That would be like in the very low teens, but we're not. We are above 15. We can't get below 15, and the skew ratio, which measures the skew ratio, which measures the risk that we have, the tail risk that we have is still, it's off of its highs, but still very high. In fact, the average is really, really high up here. So, and you can see it kind of peaks, before, when it peaks and rolls over when you are bear. See, we went into an intermediate decline here on the NASDAQ. We went into a little bit of an intermediate decline here on the NASDAQ. And then, of course, we went into an intermediate decline again here on the Russell. And so you can see coming off these peaks, it wasn't an intermediate decline on the S&P like this one was, or these were, but when this 20-day average of the skew rolls over, people are, buying way out of the money protection less. It's because they're experiencing the volatility that they had been preparing for. So we are below. You can see the current skew now is below the average. So you can see it's been below the average before when you've been bullish, like when it's been rising. There's time, well, not too many times, but you can see sometimes it will get below it while it's rising and then jump right back up. So really important for this to jump back up, because if it doesn't, then that means there's a good chance that we are going to experience some volatility, whether or not it's an intermediate pullback in the Dow only, like we've seen before, or in the Russell only, or in the NASDAQ only, whether it actually leads to a broader intermediate pullback, of course, remains to be seen there. All right, so before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube that notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon that tells us that you liked our video today, you want us to do another video again tomorrow. Comment down there. What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle at DavidSettle42. Join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things on the page, including our Market Outlook live video. Click on this image here. It takes you to our Market Outlook page where you can be able to watch today's Market Outlook live video as well as prior videos here. Again, this is where I review all old trade ideas that we've done in prior market outlooks. We closed out one of our recent trades here today, so I talk about that and why it's really important. That's probably the most important part of the trades, is the management of them after the fact. So that's why I do that. We also put on today's trade idea already before the market closed, so check that out there. Also, all of our upcoming trading rooms and classes are over here on the right. You can see all of them by clicking on trading rooms up at the top. Our schedule there. Come down here, click on this heart. It opens up a new tab. Hit that like button. Also click on this thumbs up icon. It opens up another new tab. Hit that like button there. Again, the more you do that, it helps us get our content out to all of our followers of those accounts based on how those algorithms work. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching. You can give us a click there while you're doing that. All right, let's take a look at what's driving the price action today. You can see, interestingly enough, bonds and commodities and real estate all rose up today, and equities were the biggest losers. Emerging markets especially, small cap stocks, 1%. Developed markets, you can see the Qs lagged behind the S&P. The dollar was up today. In fact, if you go back the last a couple of days, again, kind of a 2-day losing streak here. It's about 10 minutes. You can see it's the dollar's the big outlier to the upside over the last couple of days. And emerging markets had a great day yesterday, but then reversed that move. And you can see gold, because of the strength in the dollar, is the biggest loser over the last couple of days. And small cap stocks are the biggest outlier to the downside. All equities are too, but the Q is still kind of holding up there along with long-term bonds and global bonds and high-yield bonds, because the Qs, as we all know, are considered a safety trade right now. These mega cap companies that dominate the market cap weightings of these indexes, they're the bluest of blue chips right now. They are the biggest market caps. And so that's where people are flocking for safety in any kind of volatility, heading into those areas. There was something I was going to show you here too, the new highs and new low list. Let's see if I can get that back up. You can see that, again, kind of like what I showed you before, that moving average. This is also the 20-day average of this chart. We barely have dipped below that. So the average is at what, 100.1 right there, 100.1. We are at 91 today was our number that we had on the new highs minus the new lows. And you can see typically when you get negative results here, and if I go back 5 years, you can kind of see where all the negative results are. I mean, those are your big moves to the downside. There's your COVID drop, of course. There's your, remember that was a death cross actually, in terms of the 15 200-day moving averages, and that was a market sentiment decline. But the rest of these, that was an intermediate decline, intermediate decline there, and then all these other little moves that were intermediate declines on the NASDAQ, and the NASDAQ there, and the Dow here, and the Russell here, but never all the indexes together, right? Nothing, like we saw over here. Remember, that was actually at the end, which is kind of rare to get it down at the end instead of the beginning. You can see prior to 2018, there's the intermediate pullback there. You can see very visibly. You can see one there in 2016, again, very visibly. So, you notice though that how low the moving average has gotten. It's been so bullish that we've gotten down to really, really low levels. And despite it being so low, which makes it really easy, you would think, to stay above that average, because it is so low. And we were for this little good run that we've had, but now we are already back below it. So again, inflection point. We either get right back above it and stay above it, and you can see all these other times that you're bullish when it's rising. You can see there's times you get below it, but you just get right back above it, right immediately. You get right above it. So we either get right back above it, or we might get below, into the pink, which again typically signifies intermediate decline. And right now, at the very least, it'd be on the diamonds, because the diamonds are the ones that look like they're closest to an intermediate decline. So very, very important there to see, how that behaves going into the end of the week, right? So let's take a look now at some of these charts. Let's look at the dollars chart, because like I said, that was our biggest mover here on the Euro US dollar. You can see how it's come up here to that 38% Fibonacci retracement of the decline and hit it for some resistance. Now, remember, again, you don't start a retracement until you get above the 23% line. And so that's, we've started the retracement. You don't end the retracement until you're either above the 78% line, and we're just trending to the upside now, or you're back down below the 23% line, and we're back to being bearish again. So you notice we're not there yet either. We've come back down to the 23% line. We have oversold short-term sentiment. So again, we bounce off of this and stay in this retracement mode, or we break back down and the intermediate line works its way back out of bullish territory, and just like that, we are back into bullish mode for the dollar, which is again risk aversion. Right, so you take a look at long-term bonds, and you say, okay, well, they had a good day yesterday, and long-term bonds have been in neutral. They were bullish for so long, they did not get into bearish territory here and have been in neutral territory during this little dark pink shading and red line pullback that it's been getting here. And you can see also has short-term oversold short-term sentiment going into today and bounce back up there. So kind of interesting to see. And of course, we've been looking at Bitcoin as a reflection of speculation, and you can see that it's been on a near-term decline down into lower territory. A very big engulfing pattern that we got at the beginning of the week. It's still holding its ground, right? So it's got this, again, it pulled back, it broke the 23% line, it started its pullback. It's trying to end the pullback by getting back above that 23% line. 23% line on the long-term basis too, right? That's that orange line that goes back a little bit further than the black line. The black line is coinciding with the broad markets intermediate run. The orange line, it goes all the way back to the COVID low point, right? So you can see the 23% lines are actually kind of sitting right on top of each other. They're very, very close to each other, which is kind of, which shows how, most of the move has been here lately. But, you can see we have to get above those lines for this retracement to end, and it's not. And if you get back below this 38% line, then we are well still in retracement mode, which means there's not a lot of risk appetite from a tail risk from on the flip side, right? Skew measures the tail risk on the downside. This is a really good indication of speculative interest on the other side, right? From a tail perspective to the upside. This as well as other coins that are out there. Let's take a look at the sector moves and how they've been doing. So let's come over here to sector comparison, and again, you can see how important XLK and XLB have been over the last 3 months. But let's just look at here today and how things performed here today. And you can see utilities, staples, real estate, these are safe haven. XLK did not participate with the safe haven, which is kind of interesting, and which would suggest we might get a broader selling if this persists, right? If that kind of pattern persists. Here's that 2-day mark, and again, XLY has been relatively bullish because those three did well yesterday, but not so much today. So it held up, but XLK, XLC did not. They're down here, and you can see the cyclical areas: materials, energy, industrials, financials, really struggling, and they would struggle on any kind of risk aversion. They would struggle the most, which is why we are positioned the way we are for the Russell in our class portfolios, is because of this very phenomenon, because these S&P 500 sectors are more correlated with the small cap area of the marketplace than XLK, XLY, and XLC are, because of the mega cap nature of those stocks. All right, so that brings us to our trade idea of the day. It's on Home Depot. Home Depot's been on a nice sideways trend for so long. The market sentiment line's pretty much in neutral territory. The intermediate line's pretty much in neutral territory. You do have, a little bit of an upward bias, but not very much of one. It's not like we're only 1% above the moving average. We're hardly breaking out here. If you take a look at like the RSI and the CCI, you can see how we are relatively neutral there. We're below, a little bit above 100, but not above 150, and we are below. So a little bit of a bullish bias, but not directional. We are above 50, but not above 60. All right, and if you take a look at like the directional movement index here for Home Depot, both lines are between 20 and 25, so very non-directional in that regard. The Ichimoku trend cloud is very low, close to 0 on both of these levels. Both the trend quality and the noise balance, so very noisy, even though we have a bullish bias because we're above both these green and blue lines, or above the cloud, so slight bullish bias, but not strong breakout moves. You can see the Bollinger Bands. The stock is trading in the middle quartile, a little bit of, close to the upper quartile, but not breaking above the band, right? So hardly a breakout move here. It's got a very big, strong volume node here, right around that 23% retracement level of this big rally. You've got a parabolic peak that kind of sets the high. You've got this drop, with this divergent low point that sets the low, and we've been trading in between ever since. And that's the expectation, based on how the technicals are, is that we'll continue to trade in between ever since. So that sets us up for another iron condor spread that's been very good to us here lately for spreads. So we'll sell the low 20 delta, so sell the 315 by the 310, come over here to the 345, sell that one by the 350. You can see we've already done that on this trade, and we have in our class portfolio we have a condor for September. So there's our trade there for November. So full position size, because we don't have to worry about earnings going into October expiration. and we're getting about 500 bucks for that 1,000 bucks of risk instead of the typical 300 that we typically get. And you can see those break evens when I set those slices to the chart right there. That's where those break evens are. So right at the high point that we have established, and a little bit above the low point, but you can see there's some pretty strong support right where that low point is. Again, you've got that's the bottom of this volume area there. So we'd have to we'd be breaking down. Once we break that level, you're breaking down, going to lower levels, and so it's a good point to have a make or break type of a signal there. So otherwise, we'll trade kind of in this area around that big center, volume node that can act as a center of gravity and just stay as neutral as we've been in the last couple of expiration cycles. Alright, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Subscribe to us at Market Scholars as well for free. Follow us or click that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video in the comment section below. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.